Hello, everybody. My name is Mark. I'm also known as the stock market jobber. I'm a former institutional trader who now likes to teach people that are just starting out or have been trading for a while but haven't really been able to figure it out and having troubles. So I spent about 20 years as an institutional trader. I worked for the great Mario Gabelli, one of the great money managers of all time, and he hired me out of business school when I was at New York University. And then after a few years, I moved over to trade directly for Steve Cohen, who is probably the greatest trader of all time. Now he pretty much spends his time running the Mets, the New York baseball team, which he bought. And then I was head of trading at three different institutional money managers where I oversaw the trading of various strategies, everything from high frequency to deep value. And yes, we had plenty of hedge funds that we offered to our clients. So I oversaw the trading of all the hedge funds or various hedge funds. And I was also a market maker. So when it comes to trading, I probably have a lot more experience than most of the other people I've seen on YouTube here that are trying to teach. And it goes, my opinion is I've seen everything from just pure garbage to people that maybe are trying hard, but they just don't have the experience. So anyway, hopefully you'll become a member of our community and hopefully you'll subscribe to our YouTube page here. And I hope that I can help you, and I'm pretty confident that I will. So anyway, let's talk about what's going on in the market, right? This whole move, this is the S&P 500 ETF, Spider. Okay, this is the most important benchmark on Wall Street. It's the 500 stocks, obviously, that's where the name comes from. Now, this move up here was due to this whole kind of narrative that the Fed is going to pivot, right? That's the buzzword du jour, or the buzzword of the year, I should say. But the Fed is going to pivot, and that means they are going to go from raising interest rates to cutting interest rates. That would be good for the market because high interest rates are bad for the stock market. High interest rates mean companies make less money because they borrow to cover their operating expenses. If it's a higher rate, it's going to cost more. So the money comes right out of the bottom line. Now, there's no way the Fed is going to pivot, okay? First of all, they've said they're not going to. Second of all, we've had inflationary data come out. We had some more today. The PPI and CPI were higher than estimated. We had a really strong jobs report. So this is a sign that inflation is still out there. And we have the 10-year yield is getting really close to 4%. So it's pretty much trading in a range where it hasn't been in over a decade. So don't believe the hype. And this is why the market is going lower. So one of the most important things that I teach is that in financial markets, there are some price levels that just have more importance than others. We can see here, this is the 410 level. We hit resistance there, and then we hit resistance there, and we hit resistance there, right? When a market's going higher, it's because there's not enough supply or sell orders to fill all of the demand or buy orders. So the buyers are forced to be willing to pay a premium, and that forces the uptrend. When we get to resistance level, well, there's a lot of sell interest at the resistance level. The buyers can buy all they want to, and the market stops moving higher. And sometimes we get these reversals. Now, this happens because there's a lot of investors who are selling start to get the sense that there's other sellers lurking around. And they think this because the price isn't going higher anymore. So some of them get anxious and say, if I might not be able to sell at 410 and I might miss this if the stock or if the shares go lower. So I'm going to go down to 409. Someone else says, oh, that person went to 409, I'm going to go to 408, and so forth and so on. And this causes a snowballing effect. So a lot of times when we get to resistance, we get these quick sell-offs. Now support, on the other hand, is a large concentration of buyers at a particular price level. When a market's going lower, like S&P was back here, it's because there's not enough demand or buy orders to absorb all of the supply or sell orders. When we get to a support level, well, there is. And a lot of times when things get to support, they rally off of it because it's the opposite of resistance. Their buyers start to sense that there are other buyers around and they are afraid they're going to miss it. So someone might say, okay, this is the 390 level. I'll pay 391. Someone else says, I'll pay 392. Then 393 and 394. And we get a snowball effect. So that's support, that's resistance, and that's the reason why we get these moves off of it. Now, when we look at these charts, we have to understand we're looking at psychology. Why would a support level convert into a resistance level, like happened back here? Well, it's because of buyer's remorse. There are a lot of people who bought here who regret doing so when the price goes lower, and they tell themselves they want to get out, but they're only going to do so if they break even. So they put their sell orders at the same level they had their buy orders at. If there's enough remorseful buyers placing sell orders at what was a support level, the level will turn into resistance. Then we can see here it turned back into support. Now, why would that happen? Well, this is seller's remorse. A lot of people regret selling after the price goes higher, and they tell themselves they're going to buy their shares back, but only if they can get them for the same price they sold them at. So we can see here clearly that certain price levels are more important than others. This 390 level is very important, going back to last May. And I think we're going to reach it, and I think we're probably going to get some kind of a bounce there that will be tradable. And we'll see from there. I think we're probably going to continue to go lower. And let me just show you a more close-up or shorter time frame. So here's a shorter time frame. This is just the same thing but year to date. Notice these what we call gaps, right? These are price levels where the stock or the shares don't trade. And this particular day we closed here, and the next day we opened here. The next day we opened here and closed here. Notice how there's some space in between them. Well, that shows really aggressive selling, right? The sellers are really aggressive. And when you have really aggressive selling at the beginning of a trend, see, this is our uptrend. Yeah, so that's our uptrend. When you have really aggressive selling at the beginning of a new trend, so you notice how we had an uptrend, then we had this uptrend. Sorry, I'm not a very good drawer. I'm a better stock trader than I am artist. So then we went into a sideways trend, and now we're going into a downtrend. So this is a new trend that's starting. When you get these gaps at the beginning of a new trend, they tend to have follow through. All right, you get gaps at two different places at the beginning of new trends, and we call those breakaway gaps. And if we get a gap after we've been in a trend for a while, that could be a negative sign. That's what we call an exhaustion gap. Like this right here is your classic exhaustion gap. Now, why does this happen? Well, this is people who said they've been on the sidelines just waiting and waiting and waiting to get a better price. And they finally say, you know what, I'm sick of watching this thing go higher. I'm just going to go out and buy it. Those are the types of traders or investors that tend to be the last people to the party. So new trend gaps tell us that there's a good chance the trend continues. After a trend has been intact for a while and we start getting gaps, it could tell us that the trend is coming to an end. So there's breakaway gaps and there's exhaustion gaps. So today we are trading right down here. So we're continuing to gap lower. We had a little bit of consolidation for 3 days around the 400 level, and that's not surprising. Notice how it was resistance here and support here. People like nice round levels. So a lot of investors say, you know what, if it gets to 400, I'll sell it. Or if it gets to 400, I'll buy it. But here we have the seller's remorse converting its resistance level into support. And we had a little bit of support, but now we're decisively below that. All right, let's go take a look at the Qs. This is the NASDAQ 100. It's the 100 biggest companies on NASDAQ that don't include financials. And we can see here, we got this example of resistance here. Resistance here, converted into support here. All right, seller's remorse. Remember, people sell, the price goes higher. A lot of these investors regret selling and they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So we have remorseful sellers placing buy orders. And we had the same thing up here, resistance. Q's found support there for 3 days, but now we look like we're getting below it. When a price trades below a support level, we say the support is breaking. And that's not just symbolic. It tells us something. Every chart needs to be looked at through the prism of supply and demand. What does it tell us about supply and demand? Now, chart reading has kind of a bad reputation, but unfortunately it deserves it. That's because a lot of people don't really know what they're doing. And I will tell you this, these esoteric techniques like Elliott wave and Fibonacci, Gann theory, in the institutional world, those things just do not exist. People don't waste their time with that. That stuff is science fiction. Oh, look, here's another perfect example of an exhaustion gap here. Right, so right towards the end of the trend. People in the institutional world look at things like what I teach at Stock Market Jobber. What are the important price levels? How do you recognize them? Why do support levels and resistance levels shift back and forth? What is the momentum? And we're going to look at momentum in a few minutes. What is the trend? Okay, that's it. It doesn't need to be as complicated as people seem to think it is. So there's a lot of stuff out there that is really kind of unfortunate because I think people get rooked out of money by paying for quote unquote research, which is really just garbage. I can guarantee you that a guy like Steve Cohen or Mary Gabelli does not look at Elliott waves. All right, I will guarantee you that. Um, anyway, so we could be breaking support here. This will give us some more downside. One of the reasons why is we have Apple, right? Apple was trending higher. You could even say that's an exhaustion gap there. And what did happen? We got to resistance at the same level that there was resistance back here. There tends to be resistance at former peaks for a psychological reason. There are people who bought back here who said, you know what? I made a real big mistake when the price went lower. And they tell themselves, I'm going to get rid out of these shares if I can, if it gets back up to my price. So they place their sell orders at the same level they had their buy orders. So this is another example of psychology. This is why peaks tend to occur at the same, why stocks tend to reverse when they get to former peaks. Here's our uptrend line, and we could see we were in this uptrend. We went sideways, and then we crossed the uptrend line. Trend lines are like a graphical illustration. They're not like support or resistance levels, but just the way charts are drawn. If something's moving up and then it starts going sideways, eventually it's going to cross the trend line. And that's an early sign that, hey, maybe we're about to reverse. And in this case, it was. So we have some pretty aggressive selling here too. And Apple is the biggest stock in the market in terms of market cap. So this has the potential of pulling down the whole technology sector. All right, here's something to look at here. Advanced micro devices. We can see resistance. Resistance has become support. So we're testing this support, but I suspect that we're going to break it because the broader market just looks pretty weak. But we can keep an eye on it for maybe a little bit of a bounce. But if it breaks, there's a good chance it starts to really move lower, and that's when you would buy your puts, right? I wouldn't buy them yet. I would wait until this level gets decisively broken because there's a chance that it rallies off of this. So resistance can become support. All right, I want to talk about momentum. Momentum is how far a particular security or market has moved in a given period of time. Most of the time, a stock or a market or a crypto or whatever it is that you're trading will stay within its typical or usual or historical trading range. If it gets aggressively sold and gets below that, we call that oversold. If it gets aggressively bought and it gets above the range, we call that actually did I say that right? If we get really pounded and it get below the trading range, we call it oversold. If we get aggressively bought and get above the trading range, we call that overbought. Now, the reason why this is important is because things that are overbought or oversold tend to reverse. A lot of trading strategies on Wall Street are based on the concept of reversion to the mean. Here I have these are probably my favorite indicators for momentum measurement. There's a whole slew of them. I mean, there's literally hundreds of different ways to measure momentum. I see a lot of newer traders have like all these different momentum indicators on their charts, and you don't really need that. It's all just different ways of measuring the same thing. So my advice is you pick maybe two or three and you get really comfortable with them. So we had support up here around this level, as was pretty clear, and we got I don't know what news is driving this. It might have been, I think it might have been the earnings. So the support broke, right? That tells us that the buyers have left the market. And these red lines here are called Bollinger Bands. John Bollinger is the technician who is credited with inventing them. I don't know if he really did or not, but he's certainly the person who first put them into computers and all that kind of stuff. So the red line on the top is 2 standard deviations above the 90-day moving or the 20-day moving average, and the one on the bottom is 2 standard deviations below the 20-day moving average. Now, why is this important? Well, according to statistics, 95% of all trading should be within 2 standard deviations of the mean. So if we exceed one of these thresholds, there's a good chance we're going to get a reversal. Here we got below it and then reversed. You can see up here we got above it. These overbought or oversold conditions draw momentum traders into the market. So as we can see here, this stock has been in a complete free fall, and the stock has been in a complete free fall, and as we can see, we were oversold, right? Oversold. This momentum indicator down here is called the RSI indicator. This is a different way of measuring momentum. And this occurs, or when the blue line is below this red line, it indicates oversold conditions. And when the blue line is above this red line, it indicates overbought conditions. So as you can see here, we got a little bit of a bounce. Here we got a bounce. This is the most, based on this metric or this indicator, this is the most oversold that this stock has been in its history. So I'm not saying you should buy it, but a potential strategy that traders use is to wait for the trend to break, the downtrend line breaks. So in other words, wait for it to start going back up before you buy it, because it can just keep going down and down and down and down. So a big thing about trading is don't worry about getting the best possible price. You worry about stacking the odds in your favor. So don't buy something just because it gets to support, because the support could break. But if something gets to support and looks like it's going to start to rally, well, then that's when you jump in. You're not going to get the best possible price, but you're going to lessen the odds that you get run over. Now this is Boeing, and I wanted to point this out too, because this is oversold. Notice how it's below this Bollinger Band. It's also getting to a level that was resistance, so there's a chance there's support there. Oversold stocks that get to support tend to bounce. Now, you might look down here and say, well, gee, Mark, I see that we're below the Bollinger Band, but RSI does not show oversold conditions. It's still within the range. Well, that's because, notice this 14 here. This is the default setting. This measures how far it's moved in 14 time periods. So if you were to count back 14, you would get probably something around here. So this is measuring from here to here. It's not taking into account this big sell-off here, right? So that's why it's really good to just pick a couple indicators and get really comfortable with them, because then you start to understand the nuances of things like this. Like someone might say, well, gee, that's not showing oversold, but it's because we're measuring point A to point B, and point A was here and point B was there. So we're not getting all this up here. So this could be a potential thing to have on the radar screen for a bounce. And then the last thing I want to show you is these ETFs that have just come out about a couple months ago. These are ETFs that are based on single stocks, and ETFs usually are a basket of stocks, but this is a new thing. So if you think Apple is going to go down, you could buy AAPD. It is designed to go the reverse of what Apple does. So if Apple goes down, this ETF will go up. If you think Apple is going to go up, well, you might want to consider buying this. This is designed to go up 1.5 times as much as Apple does. So if Apple's up, 1%, this will be up 1.5%. If Apple's up 2%, this will be up 3%. So these ETFs really give investors a lot of ways to get exposure. So, I mean, if you think Apple's going to go up, why wouldn't you just buy this? Because it's going to go up more. And if you're right, it would be better. But of course, it goes both ways. If you're wrong and it goes down, it's going to go down by 1.5 times the amount. So it's a risk. It's a trade-off. So we got Apple, we got Amazon, we got Google, we got Microsoft, and we have Tesla. So I just wanted to make you aware of these things' existence because they could be very useful. All right, everybody, that's it. Thanks for checking in on the Stock Market Jobber. Please sign up for our YouTube page here, or please subscribe, and I will talk to you soon. Thanks, everybody.